Hello, everybody, and thank you so much for joining us today. My name is Emma Dukes. I'm a sales director at Brown Advisory. We have a super interesting session planned for you guys. So, without further ado, I'm going to introduce our speakers, starting with Sung Park. Sung has been with the firm for 20 years. He covers large cap pharma for us, healthcare services, and also medical devices. Much more recently, we were joined by Jay Krasker, who joined us in the summer of 2025. Jay has around a decade of experience, and he helps us with areas such as life science tools. He also covers healthcare services and medical technology. And then last but not least, Gillian Reuter. Gillian helps us with a sustainable lens on the space. So thinking about risks and opportunities, this can include areas such as regulation, but also kind of overarching news within the sector. Couple of housekeeping points from me. We'd love to keep this session conversational. If you do have a question, please do submit it via the chat function. I'll remind you of this in a moment, but we'll keep our opening comments to about 30 minutes, and then we'll have lots of time for Q&A, so please do utilize it. But without further ado, Gillian, maybe we can start with you. It would be great if you could sort of set the scene on the space, maybe talk through the subsectors within healthcare, and also maybe we can touch on performance. Obviously, healthcare has been in the headlines in recent years with regard to that, but it would be great if we can maybe zoom in on 2025.
Yeah, of course. Happy to kick us off. So the healthcare sector is currently roughly 10% of the overall S&P 500 weighting. And within that 10%, we can break down healthcare into 5 different subsectors. So first, and starting with that column all the way to the left of the slide, is managed care or the health insurers. They now make up just less than 10% within the healthcare sector. And this includes companies like United Health, Elevance, and Humana, and their role is to manage the cost of healthcare for large populations. Second, we have healthcare services, which also make up a little over 10% within healthcare. And this includes a really diverse array of companies such as hospitals or providers, labs, and drug distributors. And essentially, these are those companies that are involved in delivering care and supporting the day-to-day functionings of the system. This is followed by medical devices, or really the equipment and supplies that are primarily purchased by hospitals and providers that are used to provide care. So, for example, this would include those products used in diagnostics or procedures. And medical devices also encompasses those wearables for use by the consumer themselves, which is a growing trend that we're seeing. So, collectively, devices are roughly 20% of the healthcare weighting. Fourth, we have life sciences and tools, which are another 10% category. And this subsector really represents the equipment and supplies, or the picks and shovels, so to speak, that are used by both research institutions and industry, so think pharma, across the research and development or R&D process. And that leaves us with a fifth subsector that's significant. It's 50% of the total healthcare weighting, biopharma. And biopharma are those companies that are researching, manufacturing, and commercializing drugs. And they're a key customer segment for life sciences and tools, that subsector I just previously discussed. So biopharma drives demand for life sciences through equipment and consumable purchases, as well as through R&D and clinical trial activity. And that's a theme you're going to hear throughout this webinar, this relationship between biopharma and life sciences. So conceptually, you can combine the biopharma 50% weighting within healthcare with the life sciences and tools 10% weighting, making collectively 60% of the healthcare space that is really dependent on the health of biopharma R&D spend. And then to answer the second part of your question, Emma, how did healthcare perform in 2025? I think it's most helpful to do so by breaking the year into 3 distinct periods. So at the start of 2025, we saw some rotation toward value in more defensive sectors like healthcare, as the sector had underperformed the broader market for the prior 2 years, and valuations had become more attractive. Investors were also positioning more cautiously amid uncertainty for the new political administration. So if we look at performance for the first quarter of 2025, healthcare outperformed the broader market by 11 percentage points, with only the life sciences subsector in negative territory. And life sciences being down was really a function of political uncertainty. So you may recall hearing questions regarding the funding for key research institutions such as the National Institute of Health or the NIH, or a flux of positions at the Food and Drug Administration or the FDA. If we look at the second period within 2025, it really began with the onset of tariff policy from the administration on Liberation Day or April 2nd, and then the subsequent political commentary that was focused on drug pricing policy. So this opened the possibility of pharma sector-specific tariffs and other measures, including most favored nations or MFN policy, to potentially tie U.S. drug pricing to those prices paid overseas. And with all of these incremental uncertainties, the biopharma complex, which remember from my earlier remarks includes both biopharma itself and also those upstream sectors and life science tools, moved lower 6% from early April to late September. Meanwhile, the broader market moved higher 19%. Managed care took a big step lower during this period, down 32%, largely due to margin pressure from care spend running higher than anticipated. So collectively, healthcare underperformed the broader market by 26 points during this mid-year period, more than offsetting the positive 11 points of outperformance in the first quarter. And then the roller coaster took a final turn in late September when Pfizer became the first of many companies to make an agreement with the administration to delay sector specific tariffs by 3 years in exchange for what turned out to be relatively minimal pricing concessions from a most favored nations or MFN framework. It was limited to mostly older and less mature drug assets in the Medicaid channel. And other players in biopharma quickly followed suit. So the removal of the policy overhang lifted biopharma by 23% in those last 3 months of 2025 alone. And again, life science tools also benefited, seeing 22% in gains. So in aggregate, healthcare outperformed the broader market by 11 points during those last 3 months of the year. So kind of putting it all together, healthcare ended 2025 just under 4 points shy of the price performance of the broader market at 12.5% versus 16.4%.
Thank you, Gillian. That's very helpful. I mean, very much a kind of roller coaster ride across 2025. But Sung, maybe I can bring you in here now. With that context and kind of thinking ahead for this year and the years that follow, why do we remain constructive on the healthcare sector?
Yeah, thank you, Emma. For sure, we remain quite constructive, both on healthcare as a broader sector, but also as to each of the individual subsectors within. Healthcare is positioned to benefit from a very powerful long-term secular tailwind, an increasingly aging population that continues to be sicker and more clinically complex, which will ultimately lead to continued rise in aggregate healthcare spending, and then thus the need for sustained innovation across biopharma, services, technology, to address those challenges. But if we take a step back to and revisit our broader healthcare investment philosophy, it's underpinned by two key tenets, improving clinical outcomes and also lowering costs through efficiencies. And we see a lot of investment opportunities that do one or the other or both better outcomes in addition to some efficiencies and workflow processes leading up to some intervention or cost savings downstream due to a longer term health benefits from that intervention. And so we take a step back and go assess those innovations within the context of the socio-demographic mix and the need to address these rising healthcare cost challenges. We believe there is a lot to be excited for in terms of the innovation across each of the sub-segments within healthcare, each with their own unique approach toward improving outcomes or efficiencies, be it novel modalities or more efficient therapies in undertreated disease areas, less toxic oncology therapies, less invasive devices to better address areas such as cardiovascular or stroke risk, digital or AI-enabled tools that shorten turnaround times in what remains still a very manual industry. And then speaking of AI, we do believe that the opportunities in healthcare are underappreciated. Remember, healthcare still remains a very labor-intensive sector. And at the same time, healthcare is still remains very data dependent, be it in for the purpose of developing drugs or interpreting diagnostics or aiding in clinical decisions, minimizing human errors. So we do see a lot of opportunities in AI as an enabler in healthcare. And that all in addition to the usual efficiencies to be had in the back office processes. Now, all that said, at the same time, we continue to view healthcare also as a defensive sector as well. Much of healthcare remains non-discretionary. We will still need our medicines to be refilled. Pharma will continue to brush ever closer to a set collection of patent expiration dates, all the while fending off emerging competition. And procedures will still have to largely get done. Now, for sure, there will always remain an element of risk from policy headlines. What does the HHS, CMS, or the FDA think about, either rates or pricing or approvals, et cetera? And that is indeed something that has weighed on 2026 as well, particularly within the managed care subsector. But taken all together, however, the healthcare sector, we think, offers a combination of both a defensive characteristic supported by predictable long-term spending growth, meaningful innovation that creates pockets of secular upside. And so importantly here, you put that all together and then add the valuations that have reset to historically attractive levels to where now healthcare being the lowest weighting in the S&P 500 going back to at least 25 years. So we think healthcare remains quite attractive.
Great, thank you, Sung. And that's quite a striking chart. But Jay, maybe you can talk us through a little bit how we are thinking about these secular tailwinds, how we're trying to capture them in portfolios at a subsector level, particularly where we've seen volatility. Kind of where do we go from here?
Absolutely. And Jill did a great job of laying out the whipsaw that we saw in healthcare through last year. Maybe stepping back, we believe investments in life science tools and contract research organizations will benefit because pharma is going to continue to spend. They have patent cliffs that they need to offset. And as Sung said, there's growing demand for drugs, particularly more complex drugs, these biologics or large molecules. Again, people are getting older, people are getting sicker, and then globally incomes are rising. So there's more ability to spend on healthcare. In that context, managed care plays a role in literally managing care. Again, this is not the saying no to things, but it's making sure that folks are getting the appropriate care at the appropriate time in a system that, as we've said, it's increasingly expensive. Maybe starting with life science tools, and then we'll turn it over to Sung to talk a little bit more on managed care. If I look at what happened in life science tools, I would say last year was a rolling series of uncorrelated headwinds that made a sector that is traditionally non-cyclical look and feel pretty cyclical. And it led to estimate cuts over really the past several years coming out of the COVID boom. I'm not going to name all of the issues because it'll turn into a bit of a therapy session here, but I'd point to the COVID vaccine testing boom bust, a biotech bubble, biopharma spending slowdown related to the most favored nation threat that Jill talked about, and reductions to NIH funding hitting academic and government. That said, with a dose of optimism here, I think the worst is firmly behind us. And so if we look at where we're going, stepping back for this space, the tool space more broadly, I think end markets are all at least stable, if not improving over the last handful of quarters or year and a half. Guidance resets have investor expectations in a reasonable place, and valuations are attractive relative to history and certainly relative to the S&P, as Sung highlighted earlier. Biopharma uncertainty is lower. The COVID bubble is behind us. Biotech funding has been quite strong, and we have a codified NIH budget. All of these things should bode well for an opportunity to really return to normal. And so from here, I'm cautiously optimistic that we get a continued recovery in both end markets and in the stocks. From here, we're particularly excited about Danaher, which is owned across several of our strategies. They're the largest player in bioprocessing, which is the development and manufacturing of complex biologic drugs, which is an industry that's been slowly getting better for well more than a year. Their life sciences segment will benefit from the return to normal discussed just earlier, and their diagnostics offerings are a unique competitive advantage. With that backdrop, the stock trades at a reasonable valuation, and we think it'll be an attractive compounder over time. Again, we're not trying to call a perfect bottom. It's not what we do here. But over the coming years, we're optimistic that things are set up well. Sung, maybe to add a little bit more on managed care?
Yeah, so I'll briefly touch on managed care, which has been a quite a controversial topic for the past couple of years. So first question, why is managed care still an attractive long-term space? And so simply put, for all the structurals that we've talked about, both all three of us, healthcare spending growth will simply grow faster than GDP, and that spend will continue to have to go through the health insurance system. And so we see managed care essentially as a toll booth for healthcare spend traffic, especially here in the States, be it through the employers or both the federal and the state governments. They will all have to increasingly rely on these managed care providers to best manage that cost curve growth. And on top of that, we remain very much attracted to the health insurance business model, a business model that remains very much a short cycle business where underwriting is done on an annual basis. Thus, any pricing or benefit mismatches that put pressure on margins, in the near term can be adjusted for by internal levers as to both plan design and geographic participation decisions in the subsequent years to offset for the near-term pressures on margins. Now, that said, the key external lever still remains policy decisions, and most recently, policy decisions in how much or how little CMS is willing to provide in annual rate growth for Medicare Advantage. That has been the source of most recent pressure, but this is following a wider than typical variation in this rate, both up and down, in the years immediately following COVID. At the same time, CMS is continuing to look to fine-tune its formula and how it wants to pay Medicare Advantage rates, primarily as it relates to how CMS defines and adjusts for the underlying risk profile of a member, and also in how to better account for non-core benefit spending. But then also, if you jump to Medicaid, we had a very large disruption in the Medicaid population with annual eligibility redetermination returning in 2024 after a 3-year pause due to the pandemic. If you remember, the eligibility is reconsidered on a yearly basis, and we had to pause through that during the health emergency during COVID. That pent-up 3-year period, what that did, it did really two things. It created an unusually large membership churn, with churn of roughly 30% of individuals losing coverage once the pent-up redetermination came back in 2024. And that compares to a normalized annual churn rate of something more typically in the 5 to 9% range. And so not only did it create a very unusually large membership churn, that population that remained tended to be sicker and more costly. And that in itself is fine, as states are legally obligated to pay payers at an actuarially sound rate to ensure market health. But the problem is the claims data that the states use to pay the payers, that lags by about 12 to 24 months. So we have this kind of in-between period for the states to catch up their payments to true cost. Now, as per recent updates, we are encouraged by the state responses beginning to better reflect true costs as the data cycles through. But if we put it all together, we still seem to be in somewhat of a kind of a perfect storm in this moment in time where we're digesting all of the above, all the changes in Medicare Advantage and Medicaid. Now, that said, the industry has been through similar digestion periods in the past. For example, in the years immediately following the onset of the Affordable Care Act, where payments to Medicare Advantage were reduced to match parity with Medicare fee-for-service. We think just as it was during those periods, we believe that the payers that have the scale and the breadth will again, and on the other side of this, emerge stronger and continue to remain a very, very critical partner to the CMS in managing these programs which frankly remain incredibly popular within the constituency. And importantly, from a stock perspective, from here to there, following what is currently an earnings trough cycle, as we cycle through and digest the various pieces of the storm, we see tremendous undertapped structural earnings potential over the course of the next 2 to 5 years.
Great. Thank you both. That's very helpful. I mean, maybe let's pivot slightly here, Sung, and maybe you could tell us a bit about the research process, how you guys work together. How do you assess opportunities, particularly for the longer term in this incredibly kind of technical and more recently volatile space?
Yeah, I want to start. We talked about macro and secular themes today, but I want to clarify that we are bottoms up stock pickers. And so we evaluate every company on a case-by-case basis. We don't make decisions on macro themes alone. We get to know companies deeply by using primary and secondary sources. We build networks of companies, peers, sell-siders, and do all the detailed notes, modeling, and have iterative conversations internally, and continually challenging assumptions on what we do own and what we don't own.
And maybe to jump in, I think it's important to note that we as analysts here, we don't operate in silos. It really is a collaborative process. And so, as Emma said, I joined the firm last year. I used to cover a number of subsectors at a different fund before, all within healthcare. And one of the things that attracted me to Brown was the opportunity to work with people like Sung and Jill. In many cases, Sung and I have covered the same stocks at different points in time in our careers, so we can leverage that shared experience to hopefully drive better investment decisions. Healthcare is a uniquely coordinated ecosystem where one player's action, say utilization in a hospital, will drive a reaction and a financial impact to other players, say managed care, as Sung highlighted. Uh, in this example, the first subsector of healthcare I covered when I started in the industry was managed care, which Sung leads for us here. Sung's the point person, but at a minimum, I can be a sounding board and a sanity check. And so, in the handful of months I've been here, I've seen this collaborative process in action and remain really excited about what's in front of us. On the flip side, or maybe another example, I'm the point person on Intuitive Surgical, which is a robotic surgery platform. And Sung covers Medtronic, which has a large business in laparoscopic surgery, where Intuitive is eating their lunch. And so this allows us to debate and really try to figure out what the best outcome is. I will say it's important to note here that the point person is that they are the point person. And this is all underpinned by the fact that we have a common goal in mind, and that's to get the best names in the portfolio to hopefully drive outperformance. There's competition for capital here, there's competition for best ideas, but there really is not competition between analysts. There are no egos, there's no territories. We're really just trying to get to the best outcome we can as a team. Jill, anything to add?
Yeah, I think similar to your points, Jay, one of the strengths of our research process is that we will consider any data point, factor, strategy, or really market condition that helps us to better understand the material challenges and opportunities that are facing a business. So, as a case study to kind of exemplify this, I think about the work we did, for example, on ethylene oxide or ETO emissions and how this could affect companies across our healthcare portfolio, particularly in the medical device space. So, for a little bit of brief background, ETO is a toxic carcinogenic gas, but it's used to sterilize and clean medical devices. And it's really essential because many devices are too sensitive, so they can't withstand being cleaned using heat or radiation. So roughly 50% of sterilized devices in the US are actually dependent on ETO. So that makes it really mission critical to reduce infection risks for patients, but also a potential source of regulatory and headline risk for involved stocks. So we recently analyzed the profile of a company in our pipeline that was involved in the ETO supply chain. And through this analysis, through collaborating across our team, we were able to learn that today the company is using the best available ETO emission control technology. So they're achieving 99.9% destruction of these emissions, and that's to mitigate litigation exposure as regulations continue to evolve in the space. The company is also partnering with key regulators like the FDA to reduce reliance on ETO and develop safe alternatives. And at a high level, perhaps most important through our analysis, we were also able to roughly project the magnitude of future potential regulatory costs relative to top line growth. So I think this type of holistic research really allows us to have more well-rounded stock discussions and understand, not just how a business is performing today, but what could reshape its opportunity and risk profile going forward as long-term investors.
Great, that's super helpful. Thank you, everybody, for your comments there. Just a quick reminder, if you do have a question, please submit it. We have had quite a few come through, so we'll try and rattle through as many as we can. But Jay, whilst I kind of run through the other questions, maybe you could just kick off by talking through some of the most exciting areas of the market for you now.
Sure, of course. And hopefully this came across, but we're excited about investing in healthcare companies and the opportunity in front of us. There are positive macro tailwinds. We have a population, as we said, that's aging. It's getting more clinically complex. They're demanding more care. Globally, the populations are getting richer, and richer countries can afford more healthcare innovation, which is great societally, but also great financially. And frankly, the pace of innovation is accelerating. I'm sure we'll talk AI at some point, but even beyond that, innovation begets innovation within R&D, and we're seeing that live today. Despite what's been a challenging period for healthcare stocks, the businesses themselves have made material progress. And so to avoid, but not really avoid the overused analogy of the coiled spring, it's a bit where we feel like we are today. And I think put most simply, healthcare businesses don't have a terminal value problem. If anything, it's the opposite, right? They're growing quite quickly and demand's quite high. With that positive background, as we noted earlier too, valuation sits at really attractive levels. So from all of that, again, we'll repeat, we're not trying to call a day, a week, a quarter, but we're quite optimistic about the path forward for healthcare here as long-term investors.
Perfect. And we've actually had a couple of questions along these lines, unsurprisingly, as you predicted, Jay. So AI, I guess maybe we could touch a little bit on how companies are leveraging it, what's the opportunity within healthcare, and then I guess on the flip side, what's the potential risk?
Absolutely. Yeah. And so we're, again, I want to use the same word. We're optimistic about the opportunity for AI here because, as Sung said earlier, healthcare has a lot of data, healthcare has a lot of people. And I think in both of those cases, there are opportunities to get more efficient over time. Um, Early stage R&D and drug discovery is a big area of focus. And saying, hey, can we take, make up a number, not 100 molecules, not 1,000 molecules, but 10,000, 20,000 molecules, and try to see which might have the best binding activity on a particular receptor of interest. And so if pharma companies can do this using AI, they can then narrow the pipeline down, pick the best potential candidates, and then go into actual traditional wet lab work with a higher potential hit rate. And if I look at that, I say I'm quite optimistic about that opportunity in front of us because better pipeline drugs tend to mean better outcomes over time. I would also say healthcare is quite labor intensive. It's also very regulated, so I don't think that there's much of a risk that everything's going to get ripped out and destroyed. And it's not the quote unquote break things first ethos of tech. But I do think there's opportunities for companies that rely on labor and manual processes to improve their margins on the margin. From there, I think in terms of risk, there's always something to be concerned about. There's some question about, pure healthcare IT spending, but I think it's who owns the data and it's who owns the innovation. So I see more opportunity than risk. But I'll turn it over. I don't know if Song or Jill, if you want to
Yeah,
jump
no,
in for something else.
I just want to chime in here. It's just on the risk. If we think about, AI as efficiency in the pharma R&D process, we think, hey, you know what? Efficiency's there might possibly mean that efficiency gain there might mean downstream lesser revenue opportunity. And I think if we look at the performance of the past couple weeks, couple months, with the broader AI trade, within healthcare that has been most acutely felt in the CRO businesses, the contract research organizations that essentially they do they're the outsourced clinical trial services for pharma. This segment specifically has traded down due to the kind of the AI fear, the fear that the fear that the efficiencies from AI, thus the more efficient clinical R&D spend, ultimately means less absolute R&D spend to go around to these businesses. But we believe, and our thoughts are, I think, are echoed with a lot of some of the conversations we've had with various pharma pipeline consultants and such, that the AI-enabled efficiencies that does not necessarily mean less R&D spend in aggregate. And instead, we think that aggregate spend in R&D will continue to remain an area of pretty stable growth over time. And so, for example, if you think about a pharma company and say you're the head of R&D and you've earmarked $10 billion of spend for R&D, and AI allows you to get all your assets, all your pipeline assets to whatever finish line for that year. AI allowed you to do that with only 8 billion of your original 10 billion. So you got 2 billion you have left. You are not going to take that saved $2 billion and divert that elsewhere, right? From our understanding of the long-term biopharma roadmap, we're fairly certain that the saved $2 billion will stay within R&D as the heads of R&D continue to look for additional shots on goal. I mean, we know that it's not in biopharma's best interest to allow what is a very competitive setting. You have very competitive peers to go out and outspin and out innovate. And so we understand that there are these fears of AI efficiency eating into potentially some areas of demand, but we just don't see that. We just think that innovation will continue to be invested for in this space.
Yeah, and just to jump in as well and really emphasize Sung's points and put it in perspective, there's roughly known 20,000 human diseases and only 20% of them today have an approved drug therapy. I think that's even more striking if we look at rare disease, where 95% of rare diseases currently have no approved treatment option. So I think there's plenty of room to run in terms of drug development, just to emphasize Sung's points. Many diseases still lack targeted therapies. And as Sung and Jay mentioned, I think AI has a really huge potential to unlock value here, which is exciting, right? Both from a patient perspective and an investor perspective. But then going beyond, drug discovery, thinking across the therapy life cycle, I think AI also has the real potential to improve diagnostics and clinical decision making. So I think the most obvious to think of is imaging, like echo scans. AI can be used to help analyze these scans, translate them into standardized measurements or risk scores, and potentially improve consistency among doctors and enable the earlier detection of disease, which we know is linked to improved patient outcomes. AI could also integrate that scan information within the broader patient record, as increasingly we have electronic medical records. So think considering prior lab results, imaging, medical history, all to support in really a more efficient and accurate diagnosis for patients. And then obviously there's always an opportunity to improve workflow efficiency, which I think is kind of like the most top of mind across healthcare. So healthcare still relies on many manual and outdated processes like faxing. So I think there's a real application there as well. So I think there's a lot to be excited about in healthcare in terms of AI, and just the sector in general.
Great, thank you. Super interesting. Sung, I'm going to move to you now to kick this off. We've had a couple of questions in this vein. So GLP-1s, obviously they've been in the market a couple of years now. So I mean, it'd be great to get your thoughts on how they've altered the healthcare space, and where do we go from here?
Yeah, so GLP-1s, it's a space we've been following quite a while back since our days following Novo Nordisk and kind of the origination of even the kind of the earlier generation GLP-1s. And so there was a moment in time where there was a lot of fear that the GLP-1 would have a kind of downstream effect of solving a lot of other areas in healthcare, again, leading to potentially demand destruction. We saw that most acutely in areas that had more kind of direct impact from weight loss, for example, diabetes, bariatric surgery, other areas that had the comorbidities with obesity, like sleep apnea, etc. And for the most part, we haven't seen kind of the fears kind of quite pan out. Yes, there have been some areas such as bariatric surgery, also in certain areas maybe with insulin demand in type 2 diabetics, where that may have or the need for at least insulin pumping may have been substituted for by GLP-1s. There have been some areas, some pockets of healthcare where the GLP-1 introduction has led to some change in the demand curve, but by and large, we haven't seen quite what we feared in terms of the overall change to healthcare utilization. Two things. So if we go back to 30 years, 20, 30 years ago, we go back to the statins when the first statins first emerged. In the statins, there was the outcomes that not only did statins lower the cholesterol, they also improved longer term cardiovascular outcomes. We thought that was going to be, the savior, what cured, a lot of diseases, that was going to change, really bend the cost curve in terms of both what we were seeing from visits due to cardiovascular outcomes and how we're going to account for those. And that just didn't quite pan out the way it thought, because, we as a people, and this is me as a cynical approach, we figured out how to offset the benefits of the statins. And the second thing is, it's still a little bit early. These drugs have been around for a number of years now, but we have not yet quite seen that play out in terms of just overall utilization in healthcare. The utilization in healthcare over the past year and a half, 2 years, has actually, been quite solid. And so the GLP-1s have not had quite that dent on healthcare spend yet. Maybe it's a little bit of, hey, you know what? You took the GLP-1s, you are in a better shape, and you're out now playing pickleball. So now you're going to go visit for the knee surgery anyway. And so maybe it's a little bit of that. It's offset. So over time, we've seen a lot of these promises, and we've seen, whether they're good or bad, we've seen us kind of offset that in other behaviors that continue to allow for that overall healthcare demand curve to continue to move higher over time. Now, again, we have to remain very vigilant on the individual disease states that have more direct read-through from weight loss. But by and large, and I think I've kind of taken way too long to answer a very simple question, but we still remain very vigilant on what, not only from a GLP-1s, from the adoption of the GLP-1s into competitors, but what the read-through is to the rest of healthcare. We remain very vigilant, and we remain a little bit cynical as to kind of GLP-1s as a cure-all for a lot of areas of healthcare.
Great. And then another question in the sort of R&D drug space. How do you think about competition outside of the US, Sung? So someone in particular has kind of referenced China. How do you think about that aspect of the role?
That's a very, very interesting topic. We were just at a conference not too long ago, and that topic came up quite often. It was pretty eye-opening. So I'm going to start off by saying that and this is public information. So this was on the bit of it that was cast on their own it was a webcast. The Pfizer CEO said that the threat of if you think about particularly in the overseas markets, particularly Chinese biologics, drugs that are coming out of China, that is a real threat. And not only was the threat from Chinese biologics a real threat, but that biopharma needs AI and the efficiencies from AI to offset that from the threat from China. Now, was we're much of the GLP-1 story. We're very early, but it's no secret that China has heavily invested in their biopharma program. There are a lot of drugs that have emerged and are approved overseas from China. The adoption really hasn't taken place here in the United States. That may change over time, largely in just really kind of the data trial location, in many times not taking place here in the States, and so a little bit of consternation there. But particularly in the OUS markets, we do see various, particularly emerging markets, a little bit more amenable to potentially having increasing share from China. So if you are a multinational big biopharma manufacturer, be it a Pfizer or a Merck or AstraZeneca, you need to be aware of not only what China is doing, and then perhaps look opportunistically to partner with these partner programs, with these Chinese biologics or simple drug manufacturers. Look how you can best leverage those relationships, their IP, their know-how, their speed, and to leverage their presence and leverage each other's geographic and commercial footprints as well. And that is today what we're seeing big biopharma companies do today: partner, license with these Chinese pharmaceutical manufacturers to best leverage each other's relative strengths to be able to access as best we can, and over time reduce healthcare costs for the broader world.
I'd just add here, more innovation in healthcare and more drugs coming to market are good for people, and it's good for the healthcare companies, right? So if you are a biopharma company, large pharma in particular, yes, you're developing things yourself, but you're also looking to partner and or acquire. Well, great, you have a new pool from which that you can seek innovation. If you're a life science tools company, that you're providing the proverbial picks and shovels for drug R&D, discovery, manufacturing, great, there's another drug that could be coming to market. And then the clinical research organizations. If you want to have a drug approved in the US or in Western Europe, you're going to have to run trials in the US or Western Europe. And so I look at this and say, yes, there is a rise in drugs from China, and I think that's ultimately a good thing for the system.
Thank you so much. Really helpful perspectives there. I'm going to draw it to a close. We don't want to keep everybody from too long. So thanks so much to our speakers, Sung, Jay, Gillian, and thank you very much for dialing in. We'd love to hear any feedback you have. If you have a question that we haven't answered, one of our contacts will get back to you. But any questions, do let us know, and we look forward to speaking to you soon.